Hello everyone. Welcome to today's webinar presented by Evangelical Christian Credit Union. I'm Jeremy Moore, Regional Director with ECCU, and I'll introduce our other presenters here in a moment. We're going to be talking about three major areas: historical perspectives on commercial lending, how to evaluate your ministry's financial health, and how lenders are evaluating creditworthiness today. And now I'd like to introduce our co-presenters. Again, I'm Jeremy Moore. I've been serving ministries here at ECCU since 2005. And joining me today are two people with extensive experience serving ministries' cash management and financing needs. Mike Boblet is a regional director with ECCU, and he's been serving here across the country for 12 years. His roles have included consulting and pioneering financial services solutions to some of the nation's largest church and parachurch ministries. Before joining ECCU, Mike had over 20 years of experience in sales and consulting with Fortune 500 organizations such as Eastman Kodak, Kappa Consulting, and Sybase. Mike?
Jeremy, great to be here. I'm looking forward to it.
And joining Mike and I is Don Hughes, also a regional director here at ECCU. Don has spent 28 years in credit and finance with several large financial institutions, and he has more than 12 years experience in special asset management, working to develop solutions for organizations that were struggling to meet their mortgage obligations. His background and expertise includes all aspects of commercial real estate secured lending, including ministry, income property, and construction financing. Welcome, Don.
Thanks, Jeremy. Very happy to be here and talk with all you folks today.
And so with that, before we get into the heart of it, we actually have a poll question that we're going to open up for the audience to kind of get a better sense of where everyone's coming from today. The question is, when was your last interaction with a bank about financing? And your responses to this will help us help steer us a little bit in our discussion, because certainly you will have experienced different things based on when your last conversation was with a bank about financing. I know the last couple of years it's been very interesting. And of course, we've had those conversations frequently, haven't we, guys?
Yeah, interesting to see that 76% of the folks who responded have actually spoken to a financial institution in the last couple of years. So they are going to see the results of some of the things in which we'll talk about today.
Absolutely, absolutely. That'll definitely, so they're going to know from firsthand experience kind of some of the things that we'll be discussing here, right?
You bet. I mean, that's actually a great segue to chat a little bit about, I think a good way to talk about this topic is to understand where we've come from. And as we think about kind of this historical perspective on commercial lending, I think it's good to remember where we were in the 2000s, both with churches and ministries. I think we're in a general climate of growing, and we had a fair amount of economic prosperity, I think, for the most part. We also saw during that time the value of property across the country was generally increasing, certainly more in some areas than others, but in general from early 2000s to the end of 2000s, there was a general appreciation of property values. And I think as a result that churches and ministries were looking to grow and had some capacity to grow, whether they were looking to, and a lot of that growth I think revolved around trying to have new facilities, whether they were to build facilities, buy facilities, and certainly that had an impact on really what lenders wanted to do with ministries as we looked in those years. So as we think about, you know, there was a general feeling of borrowing money was good, that churches that wanted to grow and felt like if we build it, people will come, and certainly lenders that were in a mindset that said, let's help these ministries do that by lending money. So that, I think, created a tremendous amount of growth. I think across the board, folks were more willing to be more highly leveraged, take on debt to accomplish things, take on debt to accomplish acquiring property, building property. And as we kind of got to that 2007, 2008 time when the world began to shift, I think we were coming out of somewhat of a prosperous time for ministries as well as for lenders who worked with ministries. And then, as we all know, back in the summer of 2008, the financial markets took a dramatic shift. I can remember actually sitting in New York in a diner as I was eating lunch and flashed up on the screen talking about the difficulty that Lehman Brothers and the uncertainty as to what was going to happen would they open for business the next day. All those things I think led what we now look at and really refer to as this Great Recession, and the world changed dramatically. So in '09 and 2010, I think we saw the general economic decline. We saw ministries certainly that were experiencing a loss or a decrease in income, and as a result you began to see folks who had borrowed money to grow were having some more difficult times in trying to repay that debt, which all has really shaped, I think, how lenders look at borrowers, look at ministries, and in general it with all the other outside economic pressures, we really entered into this season of tight credit. I mean, for a period of time, no one was really looking to do any loans to anyone because of the uncertainty out there.
Yeah, there was so much uncertainty. Everybody took this kind of wait-and-see approach of, hey, when does this end? Right? Not just even, so we talked about on the church side, but right, those parishioners who lost jobs meant the mortgage market for homes, all kinds of things were affected by that. But we learned a lot out of that, certainly. And Don, we kind of had some best practices for ministries that came out of that too, didn't we?
Yeah, we sure did, Jeremy. I guess during those times, we were challenged, like many of the ministries that we worked with, to better understand how to manage financing and consult with ministries that were challenged and struggling during that period. Part of that was that we identified 4 primary areas where we could focus our consulting and areas where ministries might evaluate themselves around their own health and their ongoing ability to do the kind of ministry that they were hoping to do. Those 4 primary areas were leadership, liquidity, cash management, and cash flow. As we look at those individual areas, we identify leadership, and the value of leadership, I think we determined has a key component to how a ministry runs, how they operate. Certainly there's a spiritual leadership that helps to lead a congregation to achieve the mission that the ministry is looking for. But when we look at the financial management and the financial leadership, I think we have to turn our eyes more towards the capability and the competency of those that are in leadership, those that are pulled together to make decisions about financing, budgets, expenses that are associated with the ministry. I think we saw those ministries that did that very well had actually pulled together and were proactive in their thinking about how to manage their finances and to manage the accounts that the ministry had. Moving beyond that.
And I think before we leave that, Don, that's a great, because when we see leadership, for a church, and those out there listening who are mostly in financial leadership capacity of the church, most folks think of church leadership as being just the senior pastor, right? And we've found that the ministries that have really been able to thrive through this, they may have that dynamic senior pastor, but really it's as much from a financial perspective and stewardship perspective, it's so much about the financial leadership, and then even your lay leadership, right? From a board standpoint, their involvement, and things like that. Mike, anything else to add?
Well, one of the things I think we saw too was this a diversity of leadership. So a willingness and even a proactivity in seeking the diverse background, experience, and skill set of leaders in a church, whether that is board members with various marketplace experience, whether that's ministry leaders who have some marketplace prior to that, or the mix of even board members with marketplace experience but a passion for the ministry that the church is in. So all those things I think would translate to what we see as very healthy leadership. Boards providing the right level of accountability to senior pastors willing to look to boards for the various expertise that they bring to a church or a ministry.
And even outside of the church, right? Even in the parachurch, right? The same rules apply. So as we say, senior pastor, that could apply to senior leader as well. Surrounding themselves with a good bench team is certainly important. So, Don, with that, you were going to talk about liquidity.
Yeah, absolutely. I guess after leadership, we looked at ministries that were able to put aside enough money to be able to, first of all, certainly as we experienced during difficult times, weather that storm as congregations, as we saw congregations in some cases shrinking as people moved out of the particular area to find new jobs, or just giving overall go down. Ensuring that a ministry had adequate liquidity to not only meet the immediate needs, which might even include some type of facility repair or something like that, but to take advantage of opportunities that exist out there, and also to ensure that there's enough money set aside to cover unexpected expenses that occur during that time frame. So liquidity and ensuring that you have adequate liquidity, a key component of managing the health of your ministry. Mike, any thoughts?
Well, it's just always interesting as we think about what defines ministry health. Oftentimes that definition becomes very clear when you work in an environment where folks are struggling in whatever area it might be. So when we've worked with ministries that are struggling in the area of liquidity or in the area of even a healthy managing of cash, it really helps bring into focus a healthy ministry versus one that's not as healthy. So these troubled times, I think, have helped this definition and helped to clarify the importance of some of these key financial elements for ministries.
And we already actually have some questions coming in around what is adequate liquidity. We're actually going to get into that on the lender's perspective after Don gets through this section. So stay with us. We'll answer those.
Sure. I guess moving on from liquidity, then we start to talk about cash management. When we think about cash management, we again identified one of the key components for ministries that were successful during these difficult times and had healthy financial statements were ministries that paid attention to a budget, that actually took the time to invest and create a discipline of budgeting both on the revenue side as well as the expense side, and then working that budget actively to ensure that to the extent that there was a downturn in revenue, that they could offset that with expense changes and maintain and manage their cash flow. Thoughts, Mike?
Well, it's interesting how closely linked sound cash management is with overall liquidity, that those two things go hand in hand. Having the adequate reserves to stay out of harm's way comes as a result of being able to manage budgets and cash and income and expense, and they're just very tightly linked. So to some degree it's two sides of the same coin we're speaking of here, but very, very important. And again, I think we became acutely aware as a result of working with folks who didn't necessarily have the level of expertise to weather some of the difficult financial times we've experienced the last 5 years.
Sure, and that speaks right to the cash flow aspect of this, being able to not just build a budget that's revenue driven, but build a budget that responds to the expense side as well, and to ensure that through the management of your expenses that you actually generate adequate liquidity to be able to, or pardon me, adequate cash flow to be able to fund those liquidity reserves that have been key for some ministries as they've worked through these difficult times. Jeremy?
Yeah, I was just thinking as you were saying that the expense side, the expense management really is a key piece. The revenue side, we have churches and ministries all the time that talk to us about how they don't feel like they should budget because how do they really know what's going to come in from giving? There's no dues; it's not required. People are responding. So while we can't necessarily, we can hope and forecast and plan for revenue, but we absolutely must be watching the expense side very closely, both in budgeting and then with the actuals as we go through the process. So that's good.
Right. I think we found that for the most part, the expense side is the one thing that the ministry can proactively be engaged in. The revenue side, God's gonna bring in the tithe, and God's gonna bring in the on the revenue side, provide on that. But proactively managing the expense side puts sort of the power back in the ministry to be able to help ensure that they remain healthy and they're able to meet all of their obligations both on their mortgage, but to those ministry commitments that they have out there. So absolutely important.
Right, that's the key. That's stewardship, right? Absolutely. So with that, we're going to get into some lender perspective here in a moment. But first, we have another poll question for you. And this one is: do you expect your ministry to need a loan in the next 12 to 24 months? And if so, what will be the purpose of the loan?
I think what's interesting about this poll question as they answer is that the reasons for borrowing money have changed if you compare the middle of 2000s to even today. The propensity of folks that were looking to do construction, as an example, I think that certainly has changed over these last 4 or 5 years. So very curious as to kind of where folks' mindset is today.
Yeah, look at that. It looks like actually a pretty even mix of refinance, which, as Mike, you touched on, rates are lower today than they have been typically. But then also a pretty good percentage of you, over 40%, have some thoughts about some facility expansion, which is exciting to see, right, that folks are seeing some stabilization and potential for growth.
And to some degree, probably that expresses some pent-up need that has grown over these last number of years.
Absolutely. So with that, let's go into the kind of how the lender is evaluating creditworthiness these days. And certainly financial reporting is always been something that's been important. But I know we've seen that the value of accurate and consistent and timely financial statement reporting has been more important than ever for a few reasons. I think from a lender perspective, it's important for us to be able to understand and know what we're underwriting. But from a ministry standpoint too, being able to view accurate financial statements on a regular basis has huge implications. We talked about just a minute ago being able to manage expenses. Hard to do that, if you can't look at real-time figures and figure out where you're at in relation to where you thought you'd be.
Yeah, just interesting as we begin to talk about this evaluating creditworthiness. What we're really evaluating is financial health. And so everything Don spoke about that is financial health, you figure, how do you measure that? And so key is being able to measure some type of financial reporting that is generated and is accurate and even adheres to accounting standards so that you can look at things in a very standardized method. And I think lenders today very much want to try to look at things in a standardized fashion.
Absolutely. I know, we are seeing a greater value in the CPA audit these days, even for ministries that a few years ago, maybe from a size standpoint, would have said maybe not. But between just prudent lending, but also ECFA, there's some other great organizations out there that would say, hey, if once your ministry reaches a certain size, a CPA audit makes sense. And certainly CPA involvement at some level, be it even a review, we would suggest that to the vast majority of ministries, I think, these days.
Yeah, I guess I would just add to that the fact that to the extent that your financial statements and your financial information is in great shape, it will help to expedite the process of actually qualifying your ministry for a loan. I think we often see one of the biggest delays associated with getting underwriting completed is that there's questions associated with the financial statement. So actually pulling together something that not only will serve your ministry on a daily basis as you manage your budget and manage the affairs of the ministry, but also something that the lender can use to help that'll help expedite the process is a tremendous residual benefit there.
Absolutely, absolutely. Another, we touched on liquidity as being just a good, prudent thing to have, but lenders are looking at liquidity levels a little more closely today because we've seen lack of liquidity is a risk point. So having adequate cash sitting on the sidelines is certainly helpful as you go looking for a loan today. As far as what level is appropriate, I think we see that kind of all over the map. Guys, what are you seeing as a general rule of thumb as liquid cash levels, both a minimum and ideal?
Well, again, I think it all ties into a cash management philosophy that a ministry has? I mean, we're always trying to evaluate the strength of that cash management philosophy. I mean, I know I attend a church of which we think that our low water mark never needs to be below 60 days worth of expenses. And so as we evaluate our liquidity on a monthly basis, particularly as we get to the seasons in which income is down, and as we know, expenses are very straight line. Expenses don't fluctuate with the seasons as much as income can in a church in particular. We want to ensure that we've got enough that we can cover our expenses, even if we have a week in which the giving is less than what would be expected or needed on a weekly basis to cover that week's expenses, if you will.
Yeah, no, that's good. Knowing the seasonality of your ministry too, right? You know, whether that's a church which might have a lull in the summer, or a school which might have the big give, you know, at the beginning of the school year. You know, kind of making that unique to whatever your ministry is, and building up your liquidity in advance of those lean periods when you know they're coming.
Absolutely.
But a minimum level of liquid cash certainly is something that every lender is going to be expecting you to have there today. Another thing that has always been a requirement for lenders, but is something that's a little bit more challenging in some cases today, is collateral property values, right? Loan to value, you know, is a calculation that lenders use. You know, we have, obviously we'd love for all of them to be under 50% loan to value, I think, right? But most lenders have always hung out in the under 80. Today we're seeing most of them actually wanting to be under 70, you know, for new loans. That's something that is a bit of a challenge because, frankly, your ministry doesn't have as much control over that as they do about building liquidity. It's easier to sit back, put a budget together, and build liquidity. A little tougher to influence the value of your property and as it relates to how much you owe on it.
Well, interesting. So, you know, with 40-some% of the attendees are talking about facility expansion. And so quite often as you look at facility expansion or building a new facility, you're in a situation in which the current value of your property may not provide enough collateral to borrow toward that expansion, meaning that a ministry would have to have either rely on the future value as a result of those renovations or expansion, whatever's going to happen, but also have enough cash in order to provide, you know, whether it's 25% or 30% of whatever you're going to put into that, you know, call it construction or that expansion. So again, this cash component along with a loan component go hand in hand, and certainly building into the value of that collateral. So it sounds like many folks would be looking to improve property or build facility as a result of borrowing money, which again, I think there's just a little bit more conservative approach from lenders' perspective, but certainly a desire to come along and do that.
Yeah, absolutely, Mike. I think a good portion of the folks that have joined us today are also considering refinancing. And if they haven't looked recently at what the value of their property is, they may be somewhat surprised to see that some markets have shrunk obviously more than others. But if they're anticipating that they'll be able to get financing based on what an appraised value of their property was 3, 4, 5 years ago, could be a surprise there as they look at perhaps having to bring additional cash to supplement that to create the level of equity that a lender is going to want to see in a transaction.
Yeah, I mean, it's certainly, you know, there has been a variance on how much of a decline different parts of the country have experienced, but I think it's safe to say, you know, if your last appraisal was in 07 or 08, your property will probably appraise for less today, regardless of where you are. It's been pretty universal that there has been some decline. And then we are seeing signs today of year-over-year increases in many markets. So, you know, there are certainly some positive signs out there that perhaps the worst is behind us. The next bullet, it looks so straightforward that I almost hesitate to mention it, but it's something that we need to mention. You know, you need to be considering that any lender is going to expect that you have shown the historical capacity to repay any debt you're looking to get today. So if you want a loan, you know, you need to look like a borrower that can afford that loan today. So that's as simple as really banking the funds. If you have if you're looking to refinance of existing debt, that's going to be easier for you. If you're looking to expand or purchase, you know, banking those funds and building up liquidity, but also showing historical performance of being able to make those payments will make it easier to get that loan.
Yeah, Jeremy, and tied to that, we kind of glossed over it a little bit, but when we were talking about financial reporting and this idea of building a budget and managing expenses in such a way that you actually have a positive net income, if you are going from a person that has no debt today to taking on debt in the future, in effect, that positive net income needs to look something like what your loan payment's going to be. I mean, that's one way to certainly think about it. If in the future you are going to need to borrow enough money and it results in a $10,000 a month payment, you certainly should be operating in such a way that you've got $10,000 a month available to make that payment as you look to the future.
Yeah, no question. I think one of the things that I think about regularly as we look at financial statements and the health of a ministry is it historical? Is their performance historical? Is it reliable? And is it sustainable? And so as we talk about that, looking back at a ministry's performance, the historical aspects of it are essential.
Yeah, and I don't want us to go too deep into the weeds here, but I know some of the folks out there are thinking this, and a couple of even asked it, is, what kind of is the, do we just need to be able to show the performance that we could have squeaked by, and if we had spent every, dollar that came in, we could have supported the debt? That won't get it done, right? For new loans today, most lenders use a ratio called a debt coverage ratio. I think there's different variations of what coverage ratio folks are going to look for, but I think a minimum out there generally is somewhere in the 120 to 150 range, right? Meaning that if you want to borrow $1, you need to have $1.20 to $1.50 available to pay that after all the other expenses are out there. So that's a level of detail that we won't spend too much time on, but I think it's worth mentioning that there are hurdles out there, and certainly a relationship manager can walk you through that as far as how your ministry looks with a financial health assessment to give you a sense of where you would stack up on that today. Well, and then, something that I'm passionate about is that we not are doing loans that have a negative impact on your ability to stay on mission. That is a fundamental difference, I think, between us and a lot of folks out there, is that we exist to fuel ministry, right? And so the loan, if it's fueling ministry, that's something we want to be a part of. If it's something that's going to take your focus off of ultimately what your goal is, that may be something we're going to be less interested in being involved in. Mike, you look like you had something to add.
Well, I just think as a result of where we've come from, that more and more I think ministries are actually asking the question before even a lender, before ECC would ask the question, is how is what we're looking to do going to help us accomplish our mission? And I think what I've appreciated for the 12 and a half years I've been at ECCU is that our passion is to align with that mission that a church is looking to do and come along and help figure out how that gets accomplished. And if part of that gets accomplished by being able to leverage and use financing for a piece of that, that's what's been a fun part about what we do. But I think more and more churches and ministries are both saying, let's make sure that what we're thinking about doing is absolutely in line with where we're headed. And some of that comes out of just this last 4 or 5 years of recognizing that it's extremely important that we don't do anything that would sacrifice, if you will, or impede what the ministry is trying to do as a result of a financial decision.
The building is a tool, right? Not the outcome that we're looking for in and of itself. So with that, lenders are evaluating leadership. They always have. I think most good lenders are probably taking a longer look at leadership today than maybe they have in the past. That goes both from a credit standpoint, have they met their obligations that they've had before, but also then kind of what we talked about a little bit during Don's section is that, is there a bench, right? Is there a team of people making decisions? Is there a succession plan in place? Is there more than just the one guy sitting at the table making the decisions? That's something that, I think there's some best practices certainly that we could talk about. I think probably the best, some of the best resources to go to initially, and I think we'll have a list of these that we'll send to you after the fact as well, I've mentioned ECFA once already. The Evangelical Council for Financial Accountability, great organization doing some great work, kind of setting some best practices and standards of hey, what is an ideal board size? What does that board makeup look like? How involved? Those kinds of things. Frequency of CPA interaction. So there's some good organizations. NACPA is another one that some of you may actually be involved in. The National Association of Church Business Administrators, doing some great things on the financial side of setting best practices for ministries. Guys, I know this is a hugely important area. What do you have to add here?
Well, it's interesting with leadership. One of the things that we probably don't spend as much time thinking about from a lay person in a church or an employee at a ministry, but that the structure of the organization, from a bylaw, from a governance, that those align with some of these sound financial practices, sound leadership principles. It's they work hand in hand. Having the right people, but also the right structure and the right guidelines and the right rules of the road, if you will, how to operate your organization, really have to be in place. Otherwise, I think it opens up a ministry for just potential problems.
Yeah, I think we found that those ministries that survived this last several years through the downturn in the economy were ministries that had exactly those kinds of levels of accountability, built-in board independence, and the ability for the ministry to make changes as they needed to along the way, and that the bylaws and the governance supported that at every turn.
And it's kind of interesting. What we've seen is that ministries that get themselves ready for a loan, by structuring their leadership in such a way that it makes it attractive for a lender, that's actually a secondary benefit. Really, the benefit to the ministry is enormous in the ways of just, you have less stress on your senior leader, first of all, because he has other people around him who are capable and can pick up the load. But then also your donors. I know we've seen at my church, the more information we share, the more people respond to that. So that openness, and we can do that because we have a level of accountability, and we have a set of financial benchmarks in place that allow us to be open with it and share our results, and people respond to need, and it really makes us.
I think as you look at this, I look at creditworthiness, and then you look at succession plan, and I don't think it's necessarily apparent how those are connected. But if you think about a lender who is moving in a longer-term relationship with a ministry, when you lend money to them, how important it is to understand the plan that the ministry has for a succession of a senior leader, as an example. And I think oftentimes, kind of with our boomer generation, as many of us are getting older, it's not something we thought about 20 years ago, because we all were going to live forever. But now, as many of the senior leaders in the marketplace, senior leaders in ministries are going into their 50s and 60s, I think so important to be thinking about how does this ministry continue on in the future. And as a lender, you certainly want to have some level of assurance that both the structure and the thought process is in place to allow this ministry to continue on.
Sure, if you're going to put a loan in place with a 20 or 25-year amortization, you want to make sure they're going to be around for that, right? But then, succession planning, I know we've talked about it in the past. That's an area, quite frankly, you could probably do an entire presentation on just that, and then kind of what some people are doing out there that's working well.
Sure. In my mind, it just speaks to a ministry that has a plan. The ministry has thoughtfully considered who they are, where they're going, what their real needs are, and how they're going to accomplish their objectives. As a lender, when I look at that speaks to a quality of leadership and a quality of management that is a borrower that you want to do business with.
Right, and not to mention, right, a good succession plan will set a ministry up for ministry success. And again, the loan, A borrower that's ready for a loan is a ministry that's set up to continue to do good ministry. The internal controls and financial oversight. This is another area where setting it up in a way that it meets lender approval is actually setting you up for ministry success as well. I mentioned ECFA. That's certainly a great resource. Cape and Krause is one particular CPA firm that I feel like calling out at this point because they've got some great tools and best practices around internal controls and financial oversight for ministries. Guys, do you have any specific things you want to share in this area?
Well, we've just seen a variety of examples where not only in the financial reporting area, but there are resources both from ECCU and from other organizations that can come in and actually consult and advise on how to set up a variety of internal controls, from the handling of money to the reporting of those finances, to board makeup, to even there are organizations that will consult in the area of the proper type of preparation of bylaws and constitution and those kind of things. So all those things, as we talked about, are obviously very important.
Yeah, and I think it's more of an awareness issue as opposed to an issue of just being, from an awareness standpoint, saying we've thought through these things from a lender's perspective. We understand how our business operates again, and we've laid in the controls to ensure that everything from counting the tithe to monitoring accounts payable and accounts receivable, that all of that's covered, and we've built in the appropriate levels of controls. It just speaks to a well-run business.
I think it's important for all ministries, but probably even more so for those parachurch ministries, right? I would say parachurch, that third of you out there that fits into that side, certainly a higher percentage of you are probably familiar with ECFA already because they've been out there kind of as a seal of approval in that market for longer than they have with churches. Having these things in place not only makes you a better potential borrower, but again, it makes you a more financially healthy organization, which ideally will set you up to be a good steward and do more and better ministry.
Yeah, as it says here, it's kind of this bottom line of looking like a healthy borrower. And I was with a friend of mine here just recently who's a business, has his own business, and we were talking about the need even for a commercial loan. And he kind of jokingly said, "Hey, it's easy to get money today. Borrowers want to lend money as long as you don't actually need it." And so we would suggest that you need to look like an organization that is healthy, is financially healthy, and not to go so far as the fact that if you don't need it, people will lend you money. But I think today there is a desire to come alongside ministries, provide the financial resources via a loan when it makes sense. But a ministry certainly has to do their part to look like a well-run, well-managed, healthy financial organization.
Yeah, and with that, I think we're ready to go ahead and get into the question and answer session of this. So we have some questions that have already come in. Those of you that have been holding back, you can go ahead and send those in now. We've got a bunch, so I'm going to try to do it. And some of them kind of follow a similar theme. I'm going to go back, even though I think we did touch on this after the questions came in. I think it's worth repeating. We have some questions around the guidelines for cash reserves and facility reserves. So we actually have a resource that we can use and come out and do with you, kind of a cash reserve assessment that can help you figure out what an appropriate level of facility reserves would be for your ministry based on what kind of physical footprint you have and the age of your facilities and those kinds of things. So we'd be happy to do that with you. But as far as a general guideline for cash reserves in general, Mike, you touched on it earlier, couple months?
Yeah, I think one, you can interpret it in a variety of ways. One, you could say a couple of months of expenses. So, if you were a $1.2 million a year ministry, as an example, that makes the math easy. That's $100,000 a year in anticipated expense to 2 months of expense.
For a month, right?
Well, $1.2 million a year, $100,000 a month, right?
A month.
So if you had $100,000 a month in expenses, you might want to have $200,000 in a cash reserve that allows you to kind of operate. Sometimes it's measured in terms of a percentage of income. I think most would say, 15% is adequate. Some would say you get anything less than 6%, it's way inadequate. Somewhere between 6% and 15% is probably okay, but probably needing to be built up. So those are just a few guidelines. But again, as Jeremy said, certainly a more detailed assessment can be done.
Yeah, and it certainly depends too, I think, on the size of ministry, right? And what kind of expenses you have. If all of your expenses are variable based on things you can easily turn on or off, maybe your liquidity target can be a little lower than if all of your expenses are tied to a facility and to people, which much harder to stop paying, a staff or things that are a little more painful to cut. So your liquidity target, even within those ranges, could be higher or lower based on the specifics of your ministry.
Sure, some of that can be challenging because I think we've talked about it before that some ministries, if they have $1 left at the end of the year, they feel like perhaps they haven't done all the things that they could have done. But at least just acknowledging the value of having those reserves there. Again, back to why is it important? It's important because there's opportunities that you may be able to capitalize on. There's expenses that you may not anticipate along the way that you need to cover, and to the extent that there's downturn in giving, it's an amount that will allow you to be able to not have to make hard decisions perhaps while you wait to recover there.
And I have not a question, but a request to repeat the resources. We'll actually have a resource slide at the end, but the two that I hit a couple times were ECFA, which is the Evangelical Council for Financial Accountability, and NACPA, which is the National Association of Church Business Administrators. Both great resources, and there'll have to be some others on another page as well. And then Cape and Krause I did also mention as a great CPA firm out there. Have a question here about what are your debt service ratio expectations in the current market? We touched on a range. I think the bullet for us these days is 125, right? Might want it to be a little higher or lower depending on what other factors are out there, right? If loan to value is strong.
So Jeremy,
I said debt service, and thank you. They were both giving me funny looks here. I said debt service ratio. I meant debt coverage. So let's talk about debt service ratio, because that actually is what the question is what are your debt service ratio expectations?
So typically debt service ratio is thought of as what percentage of a church's income is going to service debt. So it's, there's a variety of ways to do the math, but at the end of the day, you think about what is the appropriate percentage, and I think today it's probably easier to define the maximum than it is to define the most appropriate for any given ministry. Again, around every ministry is going to be different, but if you think in terms of a third of the money coming in goes to pay people, and you think in terms of the maximum you would ever want to spend is a third in debt service, facility, rent, if you're not borrowing but you're paying for your facility, because that would eat up 2/3 of your income, allowing a third of that to be available for ministry expense. So that's probably the most rough, but I would tell you that today I'm sure that folks would say you certainly wouldn't want it to be any more than that. You wouldn't want to spend more than a third of your income on debt service, because there's just not enough room to move things around if all your expenses are tied up in a fixed expenses.
Yeah, and I'm sorry, Jeremy.
I was just going to say it's interesting in that, with so many things that have changed, and one thing that has stayed pretty constant for us is that thought of a third and a third, right, for salaries and for facilities. And as one goes up, the other must come down, right? We'd like them to be, so answer a little more closely, I think we'd love for it to be under 30%, right, is the debt service ratio.
Yeah, that's my personal opinion, is that I frankly like to see a number it could be lower than 30%. I think the benefit of having a lower debt service ratio is that it allows you to, the three that we look at is the debt service ratio, the salary expense ratio, and then the DSCR in the end. So when you look at having a lower DSR, a lower debt service ratio, it allows you a little more flexibility around the SER, the salary expense ratio. So hedging towards something less than 70% combined, which we refer to here as a DSSR, so a debt service and salary ratio. So something less than 70% there the lower your debt service ratio is, the potentially a little more can be spent on salary and other utility expenses that then, but still allows the cushion for actual ministry cost.
And it helps you to build in that margin too, right? In case things do decline like they did in 08 and 09 and 10. We don't ever want to be budgeting to the place where we need every dollar that came in last week to come in just the same way this week in order for us to keep going. You want to build in some margin there. We have time for one more question, and it's actually one that's fairly detailed, so I'm going to reframe it a little bit. But basically the question is, do you expect to see a GAAP quality financial statements? So GAAP is generally accepted accounting principles. I would say in general, yes. We expect to see a quality of financial statements that is easily discernible from period to period, that we have confidence in the validity of, and that helps us to understand the financial results of the ministry. So anything to add to that, guys?
Well, I just think we talked about how important it is to be able to discern the income and the expense, reported in a manner that it has some consistency so that a third party can look at that and understand it. Obviously, in all you've heard here, cash flow and the ability to service debt is what we as a lender and any lender is trying to discern. So the ability that you can do that from financial statements, I think that question would go to a level of detail that even I wouldn't necessarily be able to answer very well, but it's things like, do you need to include depreciation as an expense, which is actually a non-cash item, versus not include depreciation? Something like that, I think a lender can work around and can understand, but certainly something that aligns more closely with generally accepted accounting principles is going to be a lot better than it not.
Absolutely. And I think we have one more that actually came through that I'll touch on, because we didn't touch on it earlier, and I think it's worth mentioning. All lenders typically have had a time in business rule, be it for a business or for a ministry. That feels like it may have flexed a little bit over the last few years. I think we're wanting to see more history generally than less. So church planner out there that is looking to get things going and borrow funds, I would say bank loan is probably not your first step out of the gate, right? Generally, a lender's going to want to see it at a minimum 2 full years and into the 3rd year, right? Generally, we'd like to see 3 full years of history and capacity to repay the debt, in a couple of those periods. So I would say that's something that it takes a few years to get to that place. And just came in, what is GAAP quality financial statement? Again, GAAP is generally accepted accounting principles. If you don't know if your statements are GAAP quality or not, that's a pretty good sign that you should probably get someone involved that can help you speak into that a little bit. Again, there's resources that we're going to share right now. In fact, I think this is a good time to talk through a few of those. We talked about budgeting briefly, and it's something I could spend an hour talking about. Church budgeting is something I kind of do for fun. In fact, we have a church budgeting white paper out there, and actually a budgeting webinar, a few webinar recordings, one of which I'm involved in. I probably sound a little less like a frog than I do today, right, in that one. But we've got some great resources out there. We thank you so much for being a part of this with us today. There's actually some other webinars upcoming that we'd love for you to check out as well, and some events that we're going to be at. So check those things out. Again, a copy of this entire presentation will be available to you in a couple of days, and we look forward to talking with you soon. We mentioned the financial health assessment, and I think it's worth mentioning again. If you're at that place where you're like, gosh, I don't know, what my next step is, that's really the kind of thing that we love to get in the middle of and help you with and figure out, hey, where is your ministry in relation to where you want to be financially? And we can come out and do a financial health assessment or a cash reserves consultation with you, and kind of give you some benchmarks and best practices and some direction on where to go from here. So thank you all again for being here. Don, Mike, thanks. Any last words that you guys want to share?
No, just appreciated being out here and enjoyed the opportunity to talk about something that we do every day. I mean, we're very passionate about helping ministries and working with ministries, so this is just another way to do that. So I appreciate the opportunity.
Yeah, likewise from my side. I thank you all for joining us and for participating today.
concludes our webinar, guys. Thank you all very much for being here. Have a good day.